Good afternoon, Wealth Our Way family. What is going on? It is your boy, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. Today is Wednesday, June 9th, 2021. I want to give a special thanks, heartfelt appreciation to each and every one of you who are live with me as I stream across Facebook and YouTube. And a special shout out and salute to Wealth Our Way Nation that watches us overnight, over the weekend on a pre-recorded basis, wherever they can squeeze their 15 minutes of financial literacy in. What are we talking about today? We're continuing our conversation stemming around portfolio building. I'm calling this course Portfolio Building 101. These are the basic building blocks that you need to know in order to start building wealth for yourself. So we are following the theme of house, room, furniture, where house represents the company we do business with. Room represents the type of account we choose to have at that company. And today we're going to talk about furniture. You know, when you move, you find the house. You're like, okay, yeah, this is where I want to live. You walk into the house, you check the various rooms out. You see where your kids are going to be, how much room is in the kitchen for mama to cook. Make sure the bathroom, I like to make sure the toilet height is right. I do my thing. And then after we have that, we start looking around and try to figure out how to furnish this joker. So that is a very, very key part. You don't want to have a house and nowhere to sit. You don't want to have a bedroom, nowhere to sleep. You don't want to have a kitchen and no refrigerator in it. Your furniture is very, very important. So today we're going to talk about what grows your wealth, not the company, not the account, but the actual furniture. What do I mean when I talk about furniture as it pertains to investments? Let's run down the list of what we can put into our accounts. We can choose to put individual securities. What is an individual security? An individual security is something that you can purchase, whether it is a stock, whether it is a bond, whether it is a commodity, whether it is a cryptocurrency, whether it is a unit of cash. You can purchase it individually. What else can you put into your accounts? You can put groups of assets into your accounts. You can put a mutual fund, which is a collection or a basket of securities, or an exchange traded fund, which also operates as a basket of securities. But there are vast and many differences between an exchange traded fund, which I will refer to as an ETF, or a mutual fund. So let's talk about the number one thing that the majority of Americans are using to fund their retirement, which is their employer-sponsored retirement account. Or if they're a small business owner like myself, their individual retirement account or work-sponsored company-owned retirement account. These accounts allow you and me to put a portion of our earnings away, either on a tax-deferred basis or an after-tax basis, which will not be taxed in the future. We talked about that yesterday, traditional or Roth. If we are doing this at our employer, 99.8% of the time, in fact, I would say 100% of the time, but I know if I say that, somebody's going to inbox me about their job and how don't have to worry about mutual funds because they don't have any. 99.8% of the time, you are buying funds when you are at an employer-sponsored plan. Now, the one exception to buying a fund at an employer-sponsored plan is a lot of employers will offer their company stock as an investment option to an employee. I see that a lot. When I was working in brokerage and now that I'm a financial planner, what I see is a lot of people having a huge concentration of their retirement asset in one particular security, which you guys know I think is a no-no. I talk about diversification and making sure that we spread things out when it comes to our investment to make sure our risk is spread out evenly. Why do we end up with such a high portion of our retirement plan in company stock? One major reason is matching 401k contributions. A lot of companies choose to match their employer's contribution into their retirement plan with company stock as opposed to cash. So if you're putting in $10,000 every year and you're getting matched 50 cents on the dollar in company stock, you're getting $5,000 of company stock. Well, if you're spreading your $10,000 amongst a basket of different funds, let's say you pick 4 funds, your $10,000 is being spread 2,500, 2,500, 2,500, 2,500. Then you got this one big clog of 5,000 over the years, especially if there's growth. You're going to have a high portion of your portfolio in company stock. Then you can also choose to invest in the company stock inside of the 401k, 403b, 401k, and that just doubles down on this disproportionate amount of company stock. I end up having some very interesting conversations with people, especially the longer they've worked at a company, and especially if that company's stock has performed well, trying to get them to diversify out of that stock into other assets in their 401k. A lot of people don't want to do it. They become emotionally attached to the company stock. You know, from previous 15 minutes of finance broadcast, emotions and investment, it doesn't go that well together. So what can you put into your individual retirement account? You can also put mutual funds and ETFs. So I have a question right now that says, should we max out the 401k or just up to the matching amount? So I'm going to question that this young lady, who, although I think I know she bought my book, she must not bought the book, or she hasn't read it. She bought it and gifted it to somebody else. I address that in the best use of a dollar section of my ebook, 5 Major Money Moves and 3 Money Must Do's. What I tell people is 100% take advantage of your employer match. And then I give some examples of the next best use of a dollar, that if you do not want to put everything into the employer account, you have some other choices that may work out better. With that being said, looking at an IRA, most people have to choose between a mutual fund and an exchange traded fund. If you're looking to change between those two, it's important to know the difference. A mutual fund, now it's going to sound like I'm anti-mutual fund. Let me tell you this. I don't sell mutual funds. I don't sell exchange traded funds. I am a financial planner. I encourage my clients to invest their money in the best performing, lowest cost investments. It just so happens that it's my opinion that exchange traded funds, even the ones that are set up to do exactly the same as their mutual fund counterpart, happen to perform better, happen to have less tax ramifications if you have them in a taxable account, and they cost less. The number one thing that I like about an ETF over a mutual fund, though, is its liquidity, its ability for you to get in and out of it. So if you're looking at a mutual funds, you can trade or sell your mutual fund one time a day at the end of the day. Why is that the case? A mutual fund is a basket of stocks or a basket of bonds. What happens at the end of the day is the fund manager and his team figure out what the value of the fund is based on the underlying value of what's inside of it. They chop that up by the number of shares of the fund, and they deduce what is known as the net asset value. Once they determine what the net asset value is, you can buy it. So there are certain days where the market's going down 30% and people want to get out of something that moment. You can't in a mutual fund. You put your order in and it's going to get priced at the end of the day at the net asset value. ETFs trade on the exchange. That's why it's called an exchange traded fund. They're very liquid. I have my ETF. You want it? I can sell it to you at 11 a.m., 1 p.m., 3 p.m. As long as the market is open, I can trade it. The other reason why exchange traded funds tend to perform better are their expenses are lower. The vast majority of exchange traded funds simply mock an index like the S&P 500 or the Russell 1000 or the EFA, which is the International and Far East Index. What that means is There's no manager sitting back thinking that he's a genius and that he's going to pick the right stock, and you're paying him 1.5% and financing his jet and his boat and his Bentley and his mansion because you are paying this management fee. When I think it was Warren Buffett who famously challenged one of the top hedge fund managers to beat the S&P 500 over a 10 or 15 year period, and the S&P dusted the guy off. Because over time, you cannot beat the index. There has never been anybody in the 100 and some year history of the S&P 500 who has beaten the index for more than 15 years. Legg Mason had a fund a long time ago that did it for 15 years in a row. And after year 16, they ended up giving back all of the gains that they beat the market by over that 15 years. They gave it back in 3 years. So I encourage people, you're better served to buy the indexes, whether you're doing it through a low-cost mutual fund or an exchange-traded fund. What really matters is not necessarily the furniture you put in the room. So now I'm going to put an extra slant on it. It's not just the furniture. It's the, what's that called? Feng shui. It's how you arrange the furniture. And that comes to asset allocation. Do you want to put the chair by the window or do you want to put it by the door? To the window, to the walls, till my stock market starts to fall. Y'all thought I was going to go crazy, but I can't do that on the show. Kids are watching. So the reality is that you want to put your furniture in the room in the proper way. That is what planning does for you. You end up creating an asset allocation. How much stock, how much bond, how much commodity, how much cash or cash equivalent. Did you know that there are things that are not just cash, but considered the equivalent of cash? So we have things such as money market accounts, CDs, banker's acceptance, commercial paper. These are things that are very short term in duration, have a high level of liquidity, are very stable, and they act as cash or cash equivalents. It is normally not a good idea to be invested in a fund that has a high portion of cash in it for a couple of reasons. First of all, your fund, and this also goes for those of you who work with a broker or an investment advisor, when you're paying a 1% fee to have your money managed, and let's just say you had $1 million. Let's dream for a minute. You got $1 million, and your advisor tells you always keep 5% in cash. Sounds like a good idea. You want cash for liquidity in case you want to buy something that pops up in the portfolio on sale. You also want cash because it's a buffer against the stock and the bonds going up and down. The problem is 5% of $1 million is $50,000. If you're paying your advisor 1% wrap fee on your entire portfolio, they don't take the cash part out. They charge you 1% on the 50,000 as well. That's $500 you're paying a year. $500 to have your cash watched. You don't need your cash watched. That's $500 you could be using to go to a Wealth Our Way webinar. That's $500 you could be using to be a foundational level client and get way more service. So be leery of people that charge you a fee to manage money that doesn't need to be watched, like your cash. The other reason that it's hard to handle having a lot of cash is because cash is an underperforming asset. There's a lot of safety in cash. When I used to work for New York Life, I heard a great line when they were trying to tell people why insurance was worth the purchase and worth the cost. They said, risk is free. Guarantees cost money. Safety and guarantee is what you get from cash and insurance and things of that nature. A guarantee is expensive. If you want risk, I don't know if y'all see the Rocket commercials with Tracy Morgan, and he talks about maybe, if it may happen or something like. You don't want that uncertainty. You want the certainty. So we talked about the exchange traded funds versus mutual funds, individual securities like stocks, bonds, or you can even put annuities in there, which is also more of a group. And then we talked about the asset allocation, how to arrange these things. This is the tip of the iceberg, tip of the iceberg. Tomorrow and Friday is where I get into the real nitty gritty of how to put these three things that I talked about today. I got a question about when the next webinar is. I love that. Thank you. We are starting our webinar series in July. We're going to run July through the end of the year, different webinars covering insurance, cryptocurrency, finances for married couples, pre-married couples, all types of things. So I appreciate the interest. I want you guys to know I love what I do and I love doing it for you. Remember, at Wealth Our Way, our motto is wealth is not only for the wealthy. I'll see you tomorrow. Have a great day.